Guys, all I can do is try and jump back in and try and pick up the shambles of where we were. I apologize. We get rug pulled by X. Michael was in a zone. We were all feeling it. I was feeling it. And X does what X does. I apologize to you, the listener. We deal with tech problems commonly. We celebrate when everything works, and we lament when it does not. I'll try to bring the folks back around. We were thoughtfully engaged in a conversation with Michael. Unfortunately, X rugged us. I got my boy FX for living back. Again, all I can do is apologize. All I can also do is let you know that I am committed. We are committed to really the follow through, the sense of urgency in providing a platform, providing a space for you, the learner, you the student, you the trader, to actually engage with Michael, your mentor, and with the community as a whole. And, with love, that's what we are trying to provide in the way of a platform. Uh, well, X can be X, right, David?
We got rug pull.
We got rugged, bro. We got rugged. That's all I can say is we got rugged. We were in a very nice, thoughtful conversation. And I can just tell you, X does that sometimes. It'll like disconnect, and then there's not much we can do. Um,
Let's call it random.
what's that?
Let's call it random.
Yeah, call it random, no doubt, no doubt, no doubt. Geez. Michael's probably going to be like, I was just talking, and all of a sudden, and I mean, it is what it is. I mean, it's not like it's his first. He's very familiar with what happens. The good news is we are recorded. The good news is you end one conversation, and you hit play again, and then you come back, and here we are talking again as if nothing happened. But indeed, very thoughtful, delightful one-on-one conversation with Michael. You, the listener, get to ask and implore important questions, and then the content is the byproduct. So it's wonderful when it works. It's caca when it doesn't. So we'll keep all of it going. Michael will be like, I was just talking, and then I looked and saw, and it was
Yeah, he's
gone.
back.
And
He's back.
okay, that's good.
He's pretty used to it.
Yeah, that's the thing. Everyone here is gonna understand that it's. Um, I'm just gonna laugh, Michael. That's all I can do. Oh, jeez. I don't.
We are just started,
You.
basically.
You were essentially just starting. I think so.
Oh,
I know, bro. I don't know what to tell you. Like, it's fucking X, bro. It's fucking
uh,
X. And
okay.
I can't even like I hold my breath because the best thing I can do that I know from all of the time, Michael, is trying to get a co-host helps kind of anchor the line with X. But then if X loses connection with the host, then they just drop it. And that's just kind of what it is, the quote unquote rug pull that I found, technically, whatever. But we're back. I have connection. I'm like, my phone's like out the window. I'm trying to get like all of my bars and hoping you can just kind of pick up wherever your flow state was, brother. And it'll go from one recording to the next. So wherever you remember you were at, feel free to just jump back in.
Okay. I basically was noting that he answered his own question when the question was proposed. This is what I heard, and this is how I'm responding. He stated that he's struggling with moving from demo to live trading, but then immediately in the next sentence says, I'm struggling to stick to one model and one approach. And that is the answer that he has to find. He has to find what model he's going to utilize. Pick one PD array. And what I was going on about was I have 81 of these things, and it's not required for you to know all of them. If I just would have taught just the fair value gap and never did anything else, you have more than is necessary. Like it's easy. It's easy to do that. What makes it hard is when I teach, and this is what I was bloviating about. Every time I teach something new in the comment section of my YouTube channel, I have people that'll say, I'm struggling right now because I'm consistently profitable with this model, optimal trade entry, 2022, what you taught with the silver bullet, or I'm doing, Caleb's model, or I'm doing Cameron's model, or my dog Piper's model, whatever it is that, it's recently released. The idea is that they have found something that's working for them. And then I come out and I teach something new, a new PD array, another model. And it's their loyalty as a student that is the problem, because they feel like the next new thing I'm going to teach is going to be better than everything before it. So don't waste any more time with what they're working with right now. Drop everything and go to this new shiny object. When in fact, that's not what I'm doing. I know that there's people still, they're actively trying to study. They're actively trying to do the things that I teach in the channel, but they don't feel comfortable with the one PD array for life. They don't know which one it is for themselves. And the common denominator is they don't spend enough time with one. Minimum 3 months. If you can't do that, don't try to learn from me. And I'm not trying to be condescending. I'm being sincere when I tell you that, because if you can't give yourself, not me, you're not giving me anything, give yourself 3 months of time studying, only visualizing price action through the lens of that one PD array. How often does it give you setups? How often is it delivering on the basis on which I teach the logic around it? But you're taking that little thing, that PD array that puts you in a trade, it has to plug and play in what you understand about where the market's going to go. Where is it drawing to? Where did it draw from? Where did the market just recently engage? During the live session, I mentioned that the regular trading hours opening range gap high from February 4th, that 25,440 even, we were trading at 392. I said the next run is going to be up to the high of the regular trading hours gap from last Wednesday, February 4th. It ran right up there on the heels of meeting it, and then just went above it by a little bit, and then gave up the ghost and dropped like 90 to 100 handles. Then went all the way back up and failed to get to it again on the 10:31 a.m. Eastern 1 minute candlestick. I said during my response before we got knocked off, my question was being posed to him as, if you don't know when the market's likely to be low resistance or if it's in high resistance, that's going to be a struggling point too. So I have lots of comments that come to me from people that can do very, very well in demo, and then they go to try it in live. They're so rushed to get in there and try to make money that, much like the other gentleman that was I was counseling, telling that he's trying to front run the PD array. He's trying to get in before the PD array forms and just submit to the process of it's going to go where I said it's going to go. That's imposing your will. So I appreciate your honesty saying that you're struggling because you can't figure out what model to stick with, and that's going to always be a problem. If you don't stick to one thing and become a master of that one thing, you're not going to be consistent. You have to have a consistent approach of doing the same thing to get a baseline, and then find your problems. This problem is easy. You're not doing just one thing. So if you were questioned whether or not at 10:10 this morning, where it made the highs, and to where it is right now on a 1 minute chart for a NASDAQ, would you consider that price action over the last 2 hours? Would that be low resistance or high resistance liquidity run conditions? I'm asking the student that.
Yeah. Who was the gentleman that was on here? And I'd love for him to answer. I don't know if he fell off or not, Michael.
Okay.
Is someone listening? And
Yeah,
I don't
I would
know.
say low resistance. I would say low resistance. I'm not the one who asked the question, but I'll say low resistance.
It's actually high resistance. And the reason why it's high resistance is because the candlesticks share a lot of the previous candlesticks ranges. So it's back and forth, chop, 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 back and forth, chop, chop, chop. Then it breaks another low, and then it resumes back into a range, and it breaks another low and resumes into a range, and that's high resistance. So I've seen many people that have transitioned from demo into live, and this is the thing that kicks them in the rear end. This environment right here. Contrast that with the run that took place from the 948 low up to 1010. That was low resistance liquidity, where it's trying to get somewhere. It's very forgiving, even if you get slippage, even if you feel a little hesitation getting in, you don't actually enter on the PD array and it starts moving in your favor because you want confirmation. When you're in low resistance characteristics, It's very forgiving. When you are in high resistance liquidity run conditions, even if you are trading with the PD array, you can get smashed because it'll come back inside the range that you think that you're leaving, and your stop loss, because you want to be real tight and short on risk, it's very easily consuming you, and it'll beat you up, even when you're right on the direction. Where did the market come from? It came from that relative equal high opening range gap high level I had in the live stream. And then it traded all the way back down to where? Sweeping the low side or the sell side liquidity pool I mentioned during the live stream. So there's two levels there that were mentioned, but it's not that all these runs here I would not be participant in because it's high resistance. It's stacking the odds of you being in a move that's clean, efficiently delivered, going to be very easy to reward you with your risk by getting you to your targets. It's going to resist that. That's what makes it high resistance liquidity run conditions. It'll go where you think it's going to go, but it's going to take a whole lot longer time. It's like riding in a car with your kids, and they all want to know when you're going to get there, and you got 6-7 hours left, and the air conditioner just broke. It's terrible, and that's what it feels like trading in those environments. So I don't try to teach my students to try to trade in every environment. There's better times to do it, and if you don't have a model, if you don't know what you're looking for, if you haven't spent time with recognition between low resistance to high resistance conditions, all of these factors. So it's not like a one answer response that fixes it. You have to have a comprehensive understanding of what it is I've taught and try to crush that desire to get out there and try to make money right away. Because that's going to be a problem with all of us. We want to make money, right? But if you're trying to rush out there and just do something and I'll trust my intuition. I'm going to look on the chart, and whatever I think if PDRA pops up, I haven't spent that much time with breakers, but it looks like there's one there because I want to get into a trade. You're going to see what you want to see, right? So you're fooled by randomness.
Yeah. Yes, exactly. Yeah. Yeah. Thank you so much. Thank you so much, Michael, for your time, for the clarification, for everything that you do. I'm forever in your gratitude. Kit, thank you. Thank you. It's been clear. It's been real. Thank you. Bye-bye.
I find it fascinating, just jumping on the 5-second and 15-second chart, even today within what we've seen in price, how much clearer you can see relative equal lows. And then when they get ran and then violently go in the opposite direction, as Michael talks about. Continuing conversation, keeping it flowing. I got my boy Mauricio in the house. I got Batman. I have not forgot about you, Batman. I've not forgot about you, buddy. Let's hit up Batman real quick first. We got Joey, we got Trader Adam here, we got Mauricio, we got a few more folks to kind of go over, keeping it salient to the conversation. Michael's here. He provided a lecture. We'd like to hear your thoughts, your feedback on what you're learning, and we did get rugged. So that's what you see in the comments there. So part 2, and Batman, you're up first. I know you're excited. Come on in, buddy.
Hello, how are you guys doing?
How you doing?
I'm doing okay. How are you, everybody? Like ICT.
Do you have a
Congratulations, you become a grandpa.
yes?
And hopefully, everybody is okay. Because today I was listening for everybody. I'm coming down, kid, because you know me. I have problems after problems, but it doesn't affect my trading.
You're
of
just
course.
talkative, buddy. You're talkative. But I like
Okay.
you, buddy. I like you're definitely excited. So we love that.
Thank you very much. The thing that I watched ICT lecture today, and because the problem that the person has before me, we had the same problem. Like I was trying to chase everything that ICT taught, but the main thing that I did is different than somebody else did. I think it works for me. When I found one model, when I start becoming like getting resolved, then I start exploring what ICT left us for us. And this is the big thing that I found for myself. It works because what today, for example, he talks about like the liquidity and high resistant and low resistant. I found everything that I have a chapters like what is these all things all about. When I enter the trade, so many people is chasing like which PDR to enter, but for me is if I don't find for my first rule is if I don't find my stop loss where I have to put my stop loss doesn't take in, then I gonna enter. Like it's just like a reverse that I do. I want to protect my money, and that's why like I found the ways that ICT taught us, like to put your stop loss. If I use in a 30 second, 15 seconds ranges, I can put my stop loss where is the range high, the range high. If I'm going bearish, it doesn't take that range, because we are seeing that we have a liquidity, we are in a low resistance, we have a news which is confirm us that it's a low resistant liquidity, right? And we have the imbalances in the left side that shows us, oh, if the left side of my market maker model is showing me that we are going to low resistant liquidity, then I'm gonna start participating which PDRA I choose. When we have a PDRA, when ICT says like 15 second charge, 30 second charge give us a lot of opportunity, it doesn't mean like it gave us like we have to enter every hour. It gives you a saw when you found your higher time frame bias, then you're gonna when you trying to enter the 15 second and 30 second charts gives you a lot of PD rate that doesn't show in higher time frame. Like for example, if we are taking the left side of the curve and we are going to bear it, we are going to take the left side of the chart and we are going to bear it. The first stage of accumulation and first part of distribution, that part of the range, if you go exploring the 15 second chart, you're going to see a lot of PD rate that doesn't show in 1 minute. And that's why it's just like fascinates me that I have these opportunities. If so, for example, some people is the other guy said, oh, when I'm trying to enter and the FVG doesn't hit, and do I have to chase? I'm not saying that you have to chase, but if you have the bias correct, the big problem is bias. If you have the bias correct and you know the target gonna hit, the 1 minute chart leave you a breakaway gap, but the 15 and 30 second chart give you opportunity to tag that FVG that doesn't breaks a 1 minute chart as a breakaway, but it gives you it comes back and hit that CB or BC, then you're gonna get it in 15 and 30 second chart, but you can't see it in 5 minutes or you can't see it in 1 minute.
Okay.
And it's the same thing of the stop loss. And for a stop loss, I'm using like some of the stop loss that you're gonna see is, for example, when I enter the trade, the stop loss should be, for example, one of them is SMT. If I put the stop loss in a fraction of 1 minute, there is a SMT for NQ and ES that doesn't hit your stop loss. It can't, because it create you have the bias correct and you have.
And that's my boy Batman coming to us nonstop. Does not stop breathing. Will talk and talk and talk. Does not stop talking. My boy Batman in his house. We love you, buddy. That's. We've had you come up each and every time, so you know there's love, and you know we're trying. But you got to breathe. You got to interact, and you can't just talk, buddy. And I know you're trying. So with love. Swing and a miss, but that's okay. Stop loss hit, but we try.
I
right?
appreciate his enthusiasm, and I think he appreciates the element of community, and he wants to feel plugged in. And I think it's admirable. I love that. That's why I like listening to all you guys talk. You have appreciation for each other, and it's not just about me. It's like all of you collectively, and I love that. That's the part I love most. And my only suggestion is, if you are given the opportunity to come up, have something that either is a noteworthy statement that you a milestone that you think is noteworthy, and it may be something other people can resonate with, like, wow, that's exactly what I was feeling, but I couldn't articulate it. And I just experienced that too, which is encouragement. Or if you have a real clear hang up or a question, I'm loving doing this, but it has to be a question because it's just like you. I don't want to listen talk about how great it is, to do ICT concepts. Nobody really cares about that. We want to know what to do with it. How are you making money with it? How can you make money with it? What are you struggling with, and how can I help you get there?
I got something to chime in on if
I,
nobody
I,
else is
I
going
I
to.
love it. I
If
love
I
it.
can
Real
ask
quick,
a
hold up,
question,
Adam. Real quick, 1 second. Batman, with love, I want
one of
you
my
to finish your thought because I think Michael's giving you a hug here, and I want you to understand it's good.
yeah,
We like hearing from you, but pretty please, when we say be valuable, add
what,
value, have something to engage or exchange with, because you come up and you just talk and you don't stop breathing, and then I have to interrupt you, and then that looks rude, and I'm not trying to be rude. Okay.
okay, sorry. I have a ADD and
I know, buddy. You don't
ADHD.
need
I
to
do have a lot
apologize. I
of
just
friends.
wanted to leave it with
Yeah.
you. Do you have anything in the way of a question? Maybe.
One of the question that I have for ICT is just like probably it's not technical. It's just like overall for me. If I'm exploring a lot of stuff, if I find a lot of stuff for my own studies, is there any way that uh, I can I can share it, or if is there any way that I can uh, uh, start seeing the things that I normally don't see it and start applying for my
Batman,
projects?
Batman, I love you. I love you. We
Hey,
it's
Kit,
just the questions. Yes.
this, let me. I'm going to say this. This is actually a wonderful opportunity to do
Hey,
this,
thank you.
and you're experiencing it too, because I know you sent me some things, and I just don't have all the time in the world to go through everything at the most opportune time. That when we send things to people, we're hoping that they go through it and appreciate the fact that we share it, and we want to get their feedback. And I know a lot of you have a high regard for my opinion, and I know you have so many things that you're discovering and you want to share with me. And I have thousands and thousands of emails that come every single week, and they're all titled, "Can you confirm this for me? Can you look?" Listen, folks, I love every one of you trying to do this. I love that you're trying it. You're implementing your own time and consideration while doing it. But imagine, okay, just for a moment, just think for a second, okay? When I was a smaller, personality of mine, when I was on Baby Pips, I could sit in the chat room and have the conversation with everybody in there, and it would be just like a one-on-one conversation for everyone. And I miss that. I really miss that level of intimacy because I know it means something to all of you because it would have meant something to me. And it feels like I'm not brushing you off. You're listening to me. I'm listening to you. We're having a real conversation. These things are highly technical. These markets are highly technical, and you're going to feel like you discovered something. You've improved on something, or you cracked my algorithm. All these things. I get thousands of these each week, and largely they go unopened because number one, I already know I'm not going to be able to deliver the response because you're going to send me something that I don't have time to go through. And it's going to sound rude. It's going to sound disingenuous. It's going to sound ignorant. Like I don't really have any real interest in all of you. But imagine if you have 2 million people all around the world, different languages, and many times they're using like chat gpt or some kind of translator, and even that doesn't really communicate well when I'm trying to read through the things that they send me. I don't have enough time in the day. Like I have family, I have my own hobbies, my own things that I want to do. And also I'm ICT on the internet. Like I'm doing these things right now. So how many people do you think that you could feel the response that you were probably sending to me in the past or considering sending to me? How much time could you personally, one person, devote? Because you're the brain trust now. I don't go to anybody and say, "Hey, look, I just got a question about this. What do you think I should say to them?" It's just me. So I don't have enough time to do it. And it's not because I have a lack of interest or desire. I would love nothing more. But I'm at a level now where there's so many people that reach out to me. I don't have the ability to have that same type of like connection. Like it's too many of you now, and it's something I miss personally. But this is why I do what I do. Like here, like I'm doing something because I like it, I enjoy it. But I know there's some of you that aren't going to get, because I got cussed out by a couple guys that you didn't stay on the stream long enough. I was going to ask you a question about this, that, and the other thing, and then I got to answer them, and it doesn't feel the same because they feel like I slighted them. So I'm damned if I do, and I'm damned if I don't. But I don't have the time to try to field everybody's model, to look at their trade. Did I do this right? What would you have done differently? Imagine that. Seriously, just imagine that. Imagine that being done to you, and you have your heart on your sleeve. You really want them to feel like you care, and that you want them to have the learning curve shortened by you, but you don't have the capacity, realistically, to answer everybody at the same time. And when you don't answer them and they don't get the response back, now you are a villain and they want to badmouth you. And that's where I've been caught in that for years now because of the growth of the community. So it's a good thing that more people know about what we're learning and engaging with, but it's not a good thing for me as the person that is kind of like the disseminator of the information. I'm caught behind a rock and a hard place. I can't do more than what I'm doing. My wife looks at me and says, "Look, why you spend so much time doing this?" She doesn't get it. I live this. Like this is my life. This is my whole thing. I wanted this when I was younger. I wanted this. You all have the benefit, not just because of me. I'm not the person or the thing that's bringing it together. It's the community that you're all working together. You're trying to build each other up. That's how it has to be. Because there's a lot of questions that a lot of my veteran students, Kit himself can answer. Majority of what comes by, questions that you're going to pose to me. I'm listening because if I hear something that isn't right, or if I hear something that I really feel passionate about it, I'm going to want to chime in. So if I get to someone and you talk and you say something and I don't respond, it's because number one, it's something I've already talked about and you probably haven't got to that video yet. And that's going to seem rude. And you want me to shorten your learning curve. If I did that for everybody, I would never get anything done. So I poured 3 decades of experience in the stuff I produce. I take my time with it. I care about what I say. I want you to learn it the right way, and there's no shortcuts. So to answer your response, I cannot take any information from you and go over it, spend time with a fine tooth comb, and give you a pat on the back and say, you're on the right path or you're not on the right path. Because the results that you're going to get is going to dictate whether you're on the right path or not. If you're getting positive feedback, you're seeing progress, and your learning curve is shortening, you don't need me, you don't need Kit or anybody else in the community to tell you you're doing the right thing. You're seeing it. But if you do have situations where you're coming up with hardships or confusion, or you just need encouragement, that's what this is for. This is for that. Because I'm listening. I may not talk all the time, but I'm listening. And if it's something I don't want to address at the time, because I may be in the car with my wife and she's being forced to listen to this too, I may not be able to say anything. I may not be able to talk at the time, but I'll bring it up later on in the conversation, usually in the same week or so. So I hope that's fair.
That's so reasonable, and I hope the listener is able to understand. Michael is engaged with Trader Roundup. He understands, you understand. He has for years now brought mentorship quality technical analysis to you and to us, the community. And he's given you an opportunity to engage with him. He is engaging with you. Now, we are, as adults in the room, asking for you to be mindful of how you blindly come up and utilize everyone's time. And we understand you're excited. We do. But we're all here to bring value, and really, really staying engaged with that is what we are imploring to you. All right. So with that said, I got my boy Mauricio, who was up here not too long ago, several weeks ago, Michael, and he gave a story, and I believe you might remember Mauricio, right? I'm not sure if you do, but I'd like you to, Mauricio, if you wanted to engage or if you had a question, pretty please feel free, jump in.
Thank you, Kit. Good afternoon, Michael. My question is relates to what you were talking over the weekend, kind of like the silver situation and the commodity situation. And I wanted to pick your brain. I know that you're more hands off right now, but when you say that you're hands off, will you say that the concepts that we learn on the higher time frame will not be working due to a manipulation? So we shouldn't be studying the price action on silver.
I'm sorry. I try that one more time. Are you asking me whether or not I believe my concepts are going to work in silver, or
Well,
what is
it's has to do with the timing as well, right? We're dealing with what has been this black swan event, Michael, and Mauricio's asking in a participant of the metals market and your recent conversation this weekend in regards to the metals market. He's trying to just get a better take on what you were talking about in regards to silver being hands off and being in this like kind of state of needing to settle, and or where your thoughts or opinions are within that really large wave that we're dealing with, the up and the down. He's asking for more clarification from you in regards to, or a follow through from the discussion we were having earlier this weekend in regards to silver. Is that correct, Mauricio?
That is correct.
okay? Thank you for that. I kind of wanted to communicate in no uncertain terms that I personally, I don't care what PDA array, what model materializes in silver, I'm not touching it. The reason why is because there is not enough physical silver for delivery. We had such a abrupt response above 120, $250,000 of movement per contract transpired over 48 hours. And where we're at technically, it's 50-50. The fundamentals behind it says sugar, silver should go to 500 or more, okay? But the physical commodity supply and the factor that it's paper silver we're trading, so it's highly manipulated. And we've had a real swan event come in. It came in and it was like controlled demolition. And where it's at right now, I personally would not feel comfortable taking on risk in silver. There's other markets to trade. And I understand that this thing could do something meteoric. It could just start blowing off and go higher and higher and higher. And it would be a move I'm not a part of. And I'm okay. I can live with that. I want you to know, as someone that's opinionated about these markets, I'm telling you that I am not going to come out later on down the road and say, now look at all the money I just made after the collapse in the silver market. I went in and I bought it all up. I'm not in silver. I'm not buying it. I'm not shorting it, because right now where it's at, it's shaking its tail, waiting for me to get close enough. And when I get close enough to it, I know it's going to bite me. And it's not going to be a handshake where I'm saying, wow, it's a long time since I've seen you, go, good friend. It's going to be painful. I'm going to get hurt. So I'm trying to communicate in very strong ways that if you are going to trade it, just know that I'm not interested in it. I'm not touching it. I'm fearful of the risks that are associated with it right now, because there's so much underneath the surface that could be going on at the exchange level that I'm not comfortable assuming that risk. So that way no one can say, you hinted at, you nudged in your little text or your post on X, or you said something that I took as a hint and I bought silver. You did not hear that from me. You did not hear that from me. I'm not trying to get in silver at all. I'm not shorting it. I'm not going long. I'm not trading the options. I'm not doing anything with it. I'm not touching it. So whatever it does from this point on, I'm interested in seeing what it does. But that collapse was, to me, the warning sign that, okay, I need to take a step back. Does it mean I'm never, ever, ever going to trade silver? No. It just means for right now, for the unforeseen future, I have to just observe it. And if things change, and I did this with Bitcoin years ago, I said, this is what I think it's going to do. This is what I think it's not going to do. Okay. And I said, these are the times I'm going to come out. I'll tell you when it's going to go to 20,000. I'll tell you when it's going to do this. I'll tell you when it's going to do that. I don't always talk about it. And I'm treating silver like a Bitcoin. It's going to be an event-driven commentary, something that's noteworthy, or I'm not going to talk about it. And I want everybody to understand that I'm not secretively trading. I'm not selling short. I'm not going long. I'm not doing any delta neutral trades. I'm not doing nothing with this. I'm not touching it. I think it's scary. I think people should realize the things that brokerage firms, even prop firms, yes, they're looking out for their best interest. They're looking into staying solvent. If all of the prop firms went bust, because everybody got lucky over leveraging in these markets. You would all be complaining about how they didn't do enough proper risk management to keep the business going. So you're all that are complaining right now, take a step back and realize that not only are they preserving themselves, but they're also by default preserving yourself too, you, because you know what you're willing to do in terms of risk. And there's just so much elevated, unrealistic measure of risk that's associated with the metals right now. It's ridiculous, and it's not worth it. How can I personally, with 34 years of experience, how can I sit here and tell you where the silver market's going to go with high degree of confidence, one way or the other, and what level it's going to go to next? I don't know. So if I'm telling you, in all honesty, I don't know what they're going to do with this market right now. I don't know. I'm actively interested in it. I personally am expecting a rug pull where they take it down below $50 by the time March contract settles. That's my personal belief. I'm okay with being wrong because I don't lose any money. But you now knowing that can come back to me later on and say, man, look at this. Silver went to 300. He was so wrong. ICT got it wrong again. And that's fun. Have fun with it. But I'm not going to lose sleep over risk. I'm not going to take a loss. But I think personally, they're doing another Hunt Brothers all over again in 1980. That's exactly what you're watching. And it ain't something that I felt comfortable looking at in hindsight moves, because I started trading in 1992. That was something that happened 12 years before I even started trading. I mean, I was only 8 years old when it happened. So I wasn't even thinking about the markets. But looking at old data, there wasn't anything in that move down that I would have looked at as a short, even today. So that's all I'm trying to communicate. I appreciate your question about it, and it gives me the opportunity to make a very clear response. So hopefully, if it was uncertain how I was referring to it over the weekend, it's pretty straightforward now.
Mauricio? Can you hear him? I cannot.
It says he's a listener for me. I don't know if
do.
that's just a glitch.
X is undefeated, ladies and gentlemen. He fell off. We'll get him, but we'll see if I can't get him back on. Let me just find him real quick. I mean, we definitely understand what Michael's saying, and I just wanted Mauricio to see if Michael had followed up with his question, or if
Yes.
he had a follow up. If he had a follow up to that at all.
No, my follow up will be just, he super clear, Michael. I've just been observing the price action on silver since the Sunday gap up, how, how it created the daily CB, and yesterday we closed over the daily CB, and now, basically we're coming back down. So just observing the price action, and I would just want to have clarification on if our concepts on ICT will still apply during these times, but you were clear on your answers. Thank you.
In response to that, I believe the next big moves are going to be in energies. So just keep your eye on crude oil. If you just look at what we've been doing, we basically cornered Venezuela, which is the largest oil supply in the world. And then now what are we doing with Iran? What do they got to do? If we take them out, we impose another puppet government in there. We don't have to worry about the strait that they always talk about, how they're going to close up. And we basically corner China and Russia, and then force them only to get oil from Russia. So World War III is coming, but we're securing all the oil that we can, both in the eastern part of the world and in our side of the world. So it's war drums beating like crazy. It's going to cause oil to go parabolic, and I'm looking for opportunities to accumulate in that. That's what I'm looking for. Silver, I'm not interested.
So
Thank you,
well
Michael.
said. Well said. Well said. Thank you, Mauricio. Great conversation. Trader Adam, I know you had your hand up, buddy, and I know you stepped in with a question. I'd love to invite you to the conversation. We got a few more folks here too. Pretty please, if you'd get a speaker tag, be succinct, be brief. And Michael, how much longer we got with you, brother?
I'm glad you asked. I'm going to hang out with you till 1 o'clock for talking terms.
Yes,
but
sir.
if you guys continue, I'll be a listener after 1.
Okay, no, that's very well put. He'll be a listener after one, everybody. So if you have any questions, pretty please put them in the comments. FX for living, if you don't mind perusing the comments, if you see any of the comments you want to put into the nest, feel free. If you don't mind, brother, much love.
Yes, for sure.
So and then we got Trader
Yeah, I can.
Trader Adam. Hopefully you can hear.
Yep.
All right,
I'm
brother.
here. Y'all hear me? Yeah. So I'm a big model 2022 type of trader. I love the market maker models and all that. That's what I trade every morning. I took a trade today off the after taking out London's low, Asia's low, and then I'm looking for that inversion. Normally I'm using the 5 minute for my inversions because like as the price has been so volatile lately, it's like a better confirmation for me to get that 5 minute inversion after the liquidity sweep. But I was watching the stream today that Michael had, and what I had noticed is basically like the real time trading hours, that high and low of the gap, like because in longs today, I took longs at 9:52 a.m. and I'm targeting London's high today, and I made like 15K profit on that because I'm trading with a pretty decent large size. And then we reversed right off of that. What was that? That real time trading hours gap high.
Regular trading
And what
hours.
Yeah,
Regular trading.
regular trading hours. I
re-
love that.
m-
The RTH, real
my
time,
mistake. Yeah,
regular.
yeah, yeah.
High five, buddy. It's all good. I mean,
Regular.
it's nice to flex how much money you make, but it's even a stronger flex to know what the R stands for. Go ahead.
You right. You right. Regular trading hours. And we reverse wrap that regular trading hours high. Uh, but I'm looking at that, and I went back testing a little bit, and I'm seeing how that's actually a great level to use for like a model 2022 type of, for the liquidity sweep. And that's like what I kind of got today from the live stream. I was also trading at the same time, so I didn't. It was like, it was kind of maybe I wasn't. I don't know if that's a correct assumption, but is that a valid level to use as the liquidity sweep to look for that level to be swept and then the inversion? Uh, because like right now I'm using previous daily lows, highs. I'm using the session highs and lows. Should I also be looking at that real time trading hours high and low as a level for the liquidity sweep?
Well, the regular
Um,
trading hours.
and then an
I
inversion.
thought you were done. I'm sorry.
No, I am done. Yep.
The
You're
regular
good.
trading hours gap from last Wednesday, we didn't explore that until overnight, last night, and this morning. So because it was left open over the last week, normally I've already counseled all of you to have your opening range gaps, keep them on a chart, some kind of workspace. Me, I'm old school. It's literally on a notepad, and it's me going back over the last 5, sometimes 7 trading days, and I'll look at where certain opening range gaps don't have the full delivery, both sides. In other words, if we created an opening range gap, if it never fills in at all, it just creates it and just drops away or rallies away from it. That's a level it's going to come back to. It's going to come back to it. And it may take weeks to get to it, but I am absolutely interested in it. Should we start gravitating towards it? Because it's going to be one of those moves that just is like a black hole. It just pulls it in like an event horizon. That was why it was salient today, because it hadn't been traded to at all. It formed, but did not get utilized at all since the 4th of last week. So every opening range gap, regular trading hours opening range gaps, whether they get filled in completely, back and forth, price action delivered, rebound, and then trade away up above or below it, even though they've been utilized, we do not discard them. So they are you could trade a model just on that. Trade one relative equal high or relative equal low to the closest opening range gap, high or low, whatever the level is, it's closest to what you think in terms of your bias. That's your model.
Drills. Ding, 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 ding. Community. I just heard gap theory, relative
Yep.
equal highs, liquidity paradigm, gap theory,
Yep.
classroom assignment.
All you have to do is have something that's going to cause you, like, what makes the market go up or down? It's liquidity or inefficiency. That's the only 2 reasons. I don't care what anybody says. It doesn't matter how many people are buying and selling. It's going up to a level to balance an inefficiency, or it's going up to engage liquidity to bring lifeblood into the marketplace. So if it's going up for either one of those two reasons, where can you key off a long entry? If you go back over the last 5 days, chances are very high that you're going to get a revisit of an opening range gap high or low, or its consequent encroachment. There's 3 levels to look at. And if it trades down into it, you can expect it to repel off of that. And the only thing you're looking at is relative equal highs and relative equal lows for the price action side. But behind those candlesticks, there may be a level like an opening range gap. And if it coexists with it, you have now one of the largest draws on liquidity that makes it easy. You can feel real confident it's going to go there. Then just simply look at any fair value gap that forms that you can frame a good risk model around. Don't over leverage it. Get in sync with that move, and then capitalize on it and close your charts and be done for the day.
Right. Right. And what you're basically explaining today is how you should be looking at the 15-second and the 5-second for that entry model, that 15-second
What did
inversion
you
or
get?
something like that.
What did you get from that? The
After
portion I talked about with the 5-second and 15-second. What specifically am I showcasing in today's live stream that you took away from it?
that I took away from it was that it's just still very chartable, and you can have a nice tight stop in these conditions, which is to me what's hard right now, because you can see that, like, obviously that the nearest swing low, or I know how you talk about how the candle, the first candle of the fair value gap, obviously 3 candle pattern, the first candle should be where your stop is, and if you're doing it on the 15-second, it allows you to afford to take more risk, uh, and not lose your shirt.
More risk. That's what he said,
And
Michael.
then,
He said more risk.
well, not more risk. I would say the same level of risk, but just with a tighter stop, right? Because if you're putting on your contract size and then using like, I use the 5-minute chart, and so I'm having to use like the first candle of the 5-minute gap, that the first. So obviously my stop's gonna be a lot wider. I have to size down. Whereas if I'm using a 15-second for the entry model, it allows me to tighten up my stop, so I can use the same, if not more
So,
size, and then
so
be wrong but not
Trader Adam,
lose.
quickly, and Michael, can we circle around to a few speakers to answer your question? And respectfully, Trader Adam, will utilize your answer in conjunction with a few other folks' answers just to get a little bit more feedback. The
Sure,
question has been,
sure.
what did you take from the 15-second, 5-second lecture part or piece? Correct, Michael? Would you like to re-engage the question, and we'll re-engage the audience to try and get a little better feedback for your question as we're wrapping up here in the last few
Sure.
minutes of Trader Roundup?
The question I have as the presenter of that stream today was, because I may not have done a good job. What I think I've done today may not have actually hit the mark I was aiming for. So if I can get feedback in regards to what you, as a viewer of the stream, what did you take away from me even mentioning the 5-second and 15-second chart in relationship to the 1-minute chart?
Okay, prerequisite. You have a speaker tag and you watched the lecture. Matthew, you're up.
Oh, hello, can you hear me?
Yes, sir.
What's going on?
Not much, brother.
Just want to say thank you for having me on. Thank you for Michael for everything you've taught us. In regards to the question, for the lower time frames, it was from what I got of it, it was just measuring the strength of the fair value gap on the lower time frame fractals on the 15 and 5. Measuring if it goes if the bodies close above the consequent encroachment of it.
Okay, I'd like this to be kind of quick. I appreciate the answer. If you've got a speaker tag, just pick up. This is a conversation. All right. Again, Trader Adam, Matthew, thank you. I'm trying to get quick response here so we can have Michael close the stream, and you providing feedback's important. Burt Trades, I know you got value, brother. Bring it, bring it.
Can you hear me all right?
Yes, sir.
All right, so what I got from it at the end was you can go to these lower time frames, such as the 15-second, the 5-second, and PD arrays you might not see on the higher time frame, 1, 2, 3, 5.
they'll show on those lower time frames. Is what I got from it. Sorry if I'm out of breath.
Hey, bro, I appreciate it. That's what you got. That's what Michael wants to hear is feedback on the lecture and how he delivers it. Keeping it going, keeping it flowing. Ryan, I
Yeah,
got
can I say what I
Mauricio
took away from it?
Gertie. Pardon?
Can I say what I took away from it?
Yes, sir, you can.
So personally, if you look on the 5 and 15 seconds, still using like the 1 and 5 minute PD arrays, even the bodies on the lower time frames are still respecting the quadrants. So that's just showing the algorithm is working. That's what I took away from it.
And I would say maybe who's also what I got from it was like, you know, you have multiple opportunities to enter, like, you know, for example, if we did invert a 5 minute for value gap after the liquidity sweep, the 15-second will offer you, you know, many more entry opportunities, obviously. So obviously, yeah, don't chase the move. And as well, yeah, it offers you a tighter stop. So you can afford to be wrong more, because what I found with the 15-second is, of course, you can get stopped up more often, but it doesn't necessarily matter, because obviously, as long as your stop's tight, your risk is set in. You can afford to be wrong a couple times, and then, you know, and still lose a lot less money than if you were just banking on that bigger stop
Beautiful.
loss.
Well said. Noted. We're
Uh,
on time. We're on a time constraint here. I'm going to keep it going. Going
yep,
to leave the
yep.
last few minutes for Michael to close. Gertie, I'm cycling through some speaker tags here, folks. Hopefully, you just jump in, can be conversational, answer the question, and we can keep it going. This is awesome. Gertie, you're up
Quickly.
next. What? Oh, I'm sorry, David. Pretty please jump in, of course.
Yes. Quickly. Just for those that still doubt about the macros, like look at a Nasdaq right now, or like today, basically. Look at when the lows of the day has formed, and look at where the high of the day has formed. Okay, and maybe you can type in the comments what do you see. Right, that's it. That's all I want to say.
I love it. I love it. Gertie, you're up next. 15 and 5 second chart. What did you get from it from today's lecture?
Hello, everyone. My bad because I joined very late, so I didn't hear the full conversation. I just want to thank Michael for everything he's doing for free for everyone, because not a lot of people appreciate him. But yeah, I didn't hear the full conversation, so I can't give a take on that. But
Okay,
thank
that's
you,
okay.
Michael, and
That's
thank you
okay,
for
bud.
having me here.
Appreciate you. Ty, you're up, Ty.
Hi, thank you guys. So what I got from it was in the smaller time frames, we have these fractals, right? So like we have the sell side and we have the buy side. So we can take on less risk by scalping, identifying that range and then taking those like 20, 40 pip trades. That's kind of what I got from it, so that you're not in this, maybe 10, 15, 20-minute trade when the market is almost rugging us all, right? So that was my take.
Ooh, I love that being the final note from the student and Michael. It floor's yours in trying to wrap up per our time frame here.
Well, thank you for that feedback. Some of the things made its way to the target, but there was this major thing I have in mind I was trying to communicate, and I'm convinced I didn't do a good enough job. So let me say it here, and then I'll demonstrate it in review tonight. I probably won't get the video up until around 8 o'clock my time, but it'll be up before I go to bed. But the idea of if you know where the draw on liquidity is, okay, if you have a bias, if you think that you know the market is strongly favored to go lower to a particular level, whether it be a single low or relative equal lows that have some kind of support around it, not support like support and just, but some kind of support in confluences, other things like a higher time frame opening range gap. It could be a new week opening gap. It could be a new day opening gap, something that's also in that same proximity. And if it can occur in the last 5 days, you have what we considered a very, very strong likelihood, because high frequency trading algorithms run on data that is compiled many times, not just on today's data and yesterday's data, but over the last week. So they get an envelope of high range value and low range value. And in deference to where that range is, they will use fixed ranges of inefficiency or, in this case, liquidity. So by having this understood, when we look at a 1 minute chart, and this is say, for instance, you believed that the market was going to go up to 25,440 because you learned what it is I taught. I told you to keep your eye on that May 4th regular trading hours opening range gap, the high and the low of it. Having those levels, it basically formed so far today's intraday high. And knowing that the 1 minute would eventually traverse up there, if you see a move originate on the 1 minute chart, and now the buy program begins, it's now starting to move higher. Now you have bullish order flow. The benefit is now you can go down into the 15-second and anticipate fair value gaps that form as a buy side imbalance, sell side inefficiency. That means it's going to be an up close candle on the 15-second chart. It's going to be a single pass, one little isolated candle, and then you can anticipate the next candle that forms over the next 15 seconds. You're going to see that form the third candle and then leave a portion of that buy side imbalance, sell side efficiency open. When it stays open, it's confirming to you that order flow is still bullish. You can use that as an entry. You can use it for stop loss management. And then going down to the 5-second, the same thing. But you're going to see porous price action reflected in these lower time frames. On the 1 minute chart, if you look at what we've done since 10 o'clock to 12 o'clock noon Eastern time, the market did in fact drop, but look how much it went back and forth in the range that was created as it dropped. It kept going back and forth, but still steady dropping. That's high resistance. We don't want to trade in those environments. You can. I have students that's done it, but it's like running a marathon with somebody on your back. It's very, very difficult, and it spends a lot of mental capital. When we see porous price action on the 15-second and the 5-second in support of, in the direction of, in the order flow run towards the liquidity that we've identified as the draw on that 1 minute chart, the 15 and 5-second are confirming order flow is in fact clean, bullish, it's staying intact, because the 1 minute chart may have, for instance, look at that run from 9:48 up to the 10 o'clock 10:10 high. There's lots of inefficiencies that open on the 1 minute chart. But inside those inefficiencies that remained open, study it on the 15-second, 5-second chart. And you'll see that the signatures are still there supporting that, yep, everything's still indicating it's bullish, even though we don't need that 1 minute to reflect it. Because if it's in low resistance, what do we really want to say? We want to say we're part of a run that the market's just ripping in our direction. We don't want to see a lot of give and take. We want to it's in a hurry to get there, which is why I teach you to look for low resistance liquidity run conditions where the market is in a fast paced hurry to get to your target, not because it's your target, because that's where it's going. By having a view and a constant reflection of the 15-second and the 5-second chart, not only are you able to manage risk appropriately, but it also affords you opportunities for you to go into pyramid and build your position up larger. Not that that's something you should strive for in the beginning, but over time, when you get better at knowing what you're doing, moving from one contract to two, you can use this approach to using the lower timeframes to afford your new entries. And in stop management, you want to keep 3 PD arrays above your stop when you're long, and you want to keep 3 PD arrays below your stop when you're short. Because after 3 of them giving up the ghost on the lower time frames, it's going to make a run on that 1 minute chart, which is what you anchored your trade on anyway. So order flow is determined by 1 minute. The micro market structure and the PD arrays that form on the 15-second and the 5-second support the underlying thesis that 1 minute charts running to that draw and liquidity you anticipated being the draw. You can take new position entries, you can manage your stop, but the key takeaway is it's telling you visually that order flow is bullish. There's no necessity for having level 2 data, footprint, none of that stuff. You don't need to see any of that stuff, because if a market's bullish, it'll leave buy side imbalance, sell side efficiencies left open and not completely closed in. And every time it makes new higher highs on these lower time frames, and it's making no attempt to get back in and do patchwork, that's going into those gaps. If it has no interest in going into them, what is it what's it signifying? It's co-signing that it's absolutely in a hurry to get somewhere. Otherwise, it would go down there and fill in those inefficiencies. It has no interest in anybody wants to buy down there. They don't care. They're getting the middle finger. See you later. Catch you next time. I'm out of here. And they're leaving like Elvis left the building. That's what you want on your trades. You want to see those signatures. If you see that, it supports confidence. It tells you to hold on to your trade. Don't lose confidence. Just hold on to it. Submit to the length of time it's going to require until it gets to your target. That was what I was aiming for. So if you didn't get it from the live stream, hopefully you got it now.
Bang.
That definitely makes sense. I appreciate that.
Bang. Speed, velocity, directional momentum seen on the sub 1 minute chart. Michael is very clearly conveying to you where and how you can utilize the breadth of a candle within the sub 1 minute chart within these seconds time frames, where and how you can see directional momentum and bias left within the chart. You can utilize and anticipate that you're on side when these inefficiencies are left open. And then you can also utilize those inefficiencies as draws later on the opposite side of the curve. Right?
The elephant in the baby pool.
Hi, can I jump in?
Pretty pleased, buddy.
Yes. So I'm really like a very newbie trader. I just um been trading for, I don't know, studying for just a little over a year, and I really like the one setup for life. But I saw also a video of Michael's mentioning about the 930 opening range, because a lot of my fellow traders here, they call it opening range breakout. Now he said that if you can get the confluences, it align with the opening range at 930. He said that he mentioned that you just need to do one just this trade, and it can change the dynamics of my family. And I'm really interested in that. If if he could direct me to that video, and plus the education where he said, ignore all my videos, other videos.
Yes.
Just listen to this one.
Yeah.
So yeah.
Yeah,
Can
those
I
are good ones. That's if I could turn back time.
yes.
That's a very good video. You could go to the Kit Trades YouTube channel if you would like. You could go to
Yes.
playlists. You'll see those are some of my favorite videos of Michael's. They'll direct you straight to his YouTube channel, but they're must see. And if I could go back in time, or if I could turn back time, and when I was 20. Those were two, in my opinion, he outlines the concepts of the daily, weekly, and monthly as just the alpha and omega in regards to your PD array. You're looking very
Okay.
specifically at the highs and lows that form within a day, a week, and a month. And then you're looking for where and how price reacts. So that lecture series is phenomenal. If someone wouldn't mind, pretty please, maybe adding that to the chat. Phenomenal observation there, Leo.
Hey, Kit, I think
Yes.
if I understand what he was saying,
Yeah.
I think he was asking about what video was I referring to only learn this, forget everything else. That's this mentorship. That's what I'm teaching this year. So every video going forward, any kind of live stream, any kind of community outreach that we're doing like right now, anything I talk about on X until my personal life says I got to take a step back, because I have my grandson. I spent the entire day with him yesterday, and I can't wait to see him again. But I don't want to drive my kids nuts. So I'm at that balancing point where I'm trying to figure out how that's going to be. But anything I produce going forward for the remainder of this year is going to be hinged on this is all you need. And it's going to be repeating the same thing that I'm going to cover tonight. It amplifies what I did in the live stream today. You'll see the actual live trade that was done. It's a small little micro contract. It was $40 or whatever. But that strategy, that mindset of going in and taking that little cookie cutter and pressing into the dough of the marketplace and punching that out and pulling it out, that's what I'm talking about. That small little, you don't have to get the full range. You ain't got to have the entire morning range. You ain't got to have the highest high and the lowest low of the day. Smallest little put in there, 15, 20 handles or pips, walk, be done. That's how every new trader should start doing it. That's how you should do it. You should only focus on that because it gives you a low threshold and barrier to get into finding consistency. You feel like you're doing it right. Think about it. If you did this and you got 20
Uh-huh.
times, I'm sorry, if you got 20 handles or points out of the NASDAQ or the ES or the Dow, if you want to trade it, if you got that out of the market 2 times a week, but you failed 3 times and you just started doing it in the first month, would you consider that progress or would you consider it still noteworthy to continue doing it?
I would call it progress.
Okay. Now, what happens when you can eventually do 3 times a week? You don't get in a
Mhm.
trade because it didn't fill you, but then you have a
Mhm.
losing trade. Would you be ecstatic over that?
Still, I mean, I would go for it.
Eventually, what you're going to discover is it's an everyday model because that's what all of you really want. But I can't walk out there when I first start teaching and say, here's how this is the unicorn that's everybody's looking for this one thing. The one thing that works every single day, no matter what market environment you're in. I don't care if it's in seek and destroy or not. This will absolutely work. You'll go out there, you'll make your ends meet if you're reasonable. If you go in, you use limit orders, you use a stop loss, it takes the market, boom, you're out, you close the charts and you go do something else. That's what I'm teaching this year.
Actually, Michael, I was inspired by that. I was googling for um one trade a month, just one trade, because I was inspired by what you said regarding if you could do this on the opening range at 9:30, it'll change the whole dynamic of my family. So um
Can
I
I ask,
want to,
like, what's a good living where you at? Like where you live, what is considered a good living on a weekly wage?
oh, here it's $2,800 for a family of 4. I'm in Canada.
Okay, so $2,000 Canadian a week is considered a good living.
Yes.
Oh, that's easy. You're gonna love this.
The
Yes,
everyday
actually.
model this year,
Yeah.
the mentorship will be, I mean, I love that. The most salient, this is all you need. This is keeping it to like, I mean, ICT's kind of saying himself that this is like the distilled down version of the most concentrated dose of his teachings. So if you're new, you're going to get that concentrated, distilled dose. So that's why you got to stay
Wow.
tuned. That's why you got to stay in, and him so much is engaging with us now and like this new layer. I mean, that should show you guys the sense of urgency that everyone has here. And
Wow.
you just need to not be a jerk on the chart. You just need to not worry about all of this stuff and focus on the technique. This is a highly technical skill, and too many people glance over how highly technical and how important it is to refine that high technical skill. If you have a very high value technical skill, is it something that you need to repeat often in order to refine and improve it? Typically, that answer is going to be yes. Ask any musician, ask any athlete. Practice makes perfect. Refinement on technicals. Technicals.
Wow.
Why is it that professional athletes are so good at something as simple as dribbling? Where you or I, all we have to do is just bounce a ball. All you got to do is kick a ball. Because it's
Yeah.
such a basic technical thing that when you're good at it, I mean, again, you're dealing with Michael here, and you literally have to be thinking about the same way a musician is trying to
Mhm.
convey technical analysis, technique. When we say technical, say technique. So you got to flick the wrist, you got to bend the elbow, you got to come up to 45 degrees. These are all very, very, very technical things that you need to pay attention to. And that's what
All right.
these are. 110, I like the time. Just thought I'd say
Uh,
that real quick. Go ahead.
can I just add something? It's sort of adding on to what was just said then. So I've been trading for the last 3 years now. I mean, I've had a few big breaks in between it, but for the last 6 months, I've really poured myself into it, and I'm still just feeling lost. So my question is like, what direction would you say to someone who's lost? And it's just, as you were saying, just to find something simple, get in, get out. I don't want the big runs. I just want something simple,
It's
easy.
literally tapping into everything that's happening right now, brother. Like, you got to realize this is the tip of the sword. This is the finger on the pulse. If you want the opportunity, if you want actuation on knowledge, you're there right now. All you have
Yeah,
to do is apply. It's not where do I go? It's not what do I do? It's hit rewind and take notes.
yeah,
You feel me?
yeah. I get you. I get what you're saying.
It's real time. You're getting the answers real time. It's a great question, but it's also understanding literally as soon as we hit the end on this, you're going back to the rewind with a fresh, sharp pencil and notes, and you're listening to every single thing that you heard from that man's YouTube channel to where and how the classroom was presented to you today in the follow-up lectures. Okay,
Yeah. Thanks.
beautiful.
Michael, is there anything you would point to say someone who's lost? What would your
Well, I appreciate you inviting him to the conversation. He has made it very clear that he is just a listener after one.
Oh
So,
yeah.
again, I appreciate you inviting him to the room, but he has politely stepped out. And I'm here to remind you and the audience that he has that right, he has that prerogative, and leave the man
Yeah.
alone. He's just here listening.
Okay.
Don't
Thank you.
give me that. I don't need your sound effects.
Sorry, that was me.
Yeah, I'm pretty sure I know what I'm doing. All right.
I pressed by
Yeah.
I pressed
No.
it by accident.
Thank
Sorry.
you.
Thanks, Kip.
It's just how not to sound cheesy, okay? We're adding value, not sounding cheesy. So, and I understand sometimes that's a mistake. I didn't mean to do it. Kit, you misunderstood. Kit, you jumped down my throat so quick. You should apologize. I get it. Guys, it's not easy doing this, all right? And some folks come up and do some just silly stuff. Mauricio Lago.
Hey, how you doing, Keith?
Pretty good, buddy. What do you got? You got some addition to the conversation here?
Yeah, I've got an addition as well as a question. So just to touch base again on what ICT said, especially a takeaway from what he explained today in the video. I think one of the things that was a takeaway for me was basically how fractal pricing is, right? As to what you expect to happen in a 1 minute, 115 seconds, or 30 seconds chart is pretty much the same as you would expect to happen, of course, on a 5 minute, 15 or 1 hour chart. Of course, the only difference between the two is one just takes longer to play than the other, right? And one thing that guys need to understand is that should we be trading something such as a second chart and looking at, take profit levels, relative equal highs or whatever the case may be, that should be something that should be really enough for a trade, right? Because we would treat it the same as if we were trading on a 15 minutes chart, because we would be looking for the same key levels for take profits, right? And that's just because of pricing is fractal.
Range values don't change regardless of the time frame, correct?
100%. And that's one of the things that I think it's really beautiful, because you don't have to, like I said, eat the entire piece of the pie. You can just be comfortable with enough just based on market structure with even trading
What's
the lower time frames.
what's fascinating about this year is we're really getting into micro market structure, aren't we, boys? We're really getting into, if
100%.
you recall, I mean, and I've only watched it several hundred times, but episode 12 of 2022, when we get into, I mean, some of the most juicy, most sought after educational points, I believe personally within ICT, are the liquidity paradigm, the intermediate term highs and lows, and exactly what we're dealing with in microstructure, right? Where and how small daisy chains of price come together and they form. And when you're dealing with subfractals on parent fractals and what that looks like, and again, these smaller time frames that are child to the parent time frames, and the idea of parent time frames, right? It's beautifully discussed. And right now, the mentorship is going over microfractals. We're going over micro market structure. The conversation today was what? It was about the 15-second chart. You're dealing with inefficiencies. And what are those inefficiencies doing? They're not filling. What are they doing? They're offering support. What are they doing? They're providing velocity, boys and girls.
That's true.
I don't mean to be the guy who reiterates loudly what Michael has been talking about the last few days, but velocity on the lower time frame is very important for you to observe. Okay, velocity. Okay.
That's true. That's true.
I know it's true. Thank you. I'm pretty sure I am able to absorb what the man is teaching. And what I am trying to convey to you, for the folks who might be a little newer, is to understand the importance of velocity. And you won't understand that if you don't look at the lower time frames. And if you don't really map what he's showing you in the way of these inefficiencies, these suspension blocks, these fair value gaps that form quickly form and don't get filled.
Correct.
To then later get filled on a sell side, right?
Yes. And also one of the other things that I just wanted to ask is it's also with regards to one of the things Michael spoke before, which has to do with regards to the commitment of traders report, and coming back to, like, for example, what he was just mentioning earlier on with regards to, you know, how the gold and the silver is playing out, whether we are still bullish and bearish. And I'm not sure if this is something Michael will answer now. That I doubt he will. But it
Again,
would be
he's a
nice.
he's a listener.
Yes.
So
But
on behalf of Michael, I will happily, as he has, mentioned, I will do my best, and we as a community will do our best to address any of these questions. And with him being a listener, if
yes,
he would like, then he could re-engage. Otherwise, he's in the car with his wife, just listening, hanging out.
not a problem. Yes, yeah. So it would be nice if maybe once in future we could maybe have a discussion with regards to that and see how effective it still is within these times where the markets
Well,
are
let me ask you
currently.
something, just out of curiosity. Do you
Yes.
think is the government open or closed right now?
Well, it's open.
Okay. How much value would you put into the government reports that are coming out within the current events? Would you say things like the commitment of traders and things like the Fed announcements are occurring punctually and truthfully, or are they not on time and less reliable? In regards to classic last 10 years, what we look at with COT versus real life, real time global events.
To be honest, to my experience, I don't think it really has been much of help, even though it's a difference between non-commercials and commercials. People basically trying to battle against one another, right? So I don't see it as
We're
much.
dealing with some. I mean, that is, of all the different concepts, we could say maybe the reporting that's coming from some of these institutions is delayed, and or maybe not something as traders we should be putting too much faith in. Maybe.
Yeah. Well, I agree.
Maybe it just has to do more with the time of the year and not the actual class, not the actual things that were discussed over a decade ago, 2 decades ago, 3 decades ago, and the importance of the commitment of traders, correct? We understand what it is
Correct.
classically, but we also understand the shit show that we're living right now, right?
Yes.
Okay.
I agree.
So if it's not as big of a weighted confluence right now, then we also understand why. Fair?
Yes, fair enough. I guess market structure still will always remain
Micro structure is where we're getting no.
Yes.
We get market structure, but again, we're dealing with right now micro market structure, which is giving you the market in HD. You're able to see things on lower time frames that the average person can't see, that the average person isn't even looking for, that the average institutional participant is completely oblivious to. You, the small participant in the market, get to look at the smallest time frame and get to see things completely different
in real time.
in real
In
time.
real time.
And the whole point in
Okay.
all of this is you don't need depth of market. You don't need volume profile. These things that have been borderline controversial, at least on the trends side of my feed, are exactly the points where and how Michael made these points, made these statements, and now he's showing you directly why he said what he said. Depth of market doesn't mean shit. You want to know why? Because you can't see the clarity in the market in high definition in real time the way that he's explaining the breadth of a candle. His concepts are showing you how to read the breadth of a candle. Period.
Hey, Kit.
Yes, sir.
On the topic of the commitment traders reports and the data that's coming out, let me ask you a question. In vein of conspiratorial theory, imagine if the world were in fact very corrupt, and that's hard to imagine. But imagine a time when the markets, the world leadership is in a state of massive corruption. What benefit would it be to delay the data, make the data unavailable to the average person, while those in the circle of Nancy Pelosi type individuals, they can position themselves, I don't know, ahead of the silver collapse or ahead of another market that's getting ready to do something that clearly we could see coming if the commitment traders reports were released on a timely basis without interruption and we could trust the data. Do you see how that might be a potential for further corruption and greed?
I assume so, because I guess it's something that they want us to see and not really based on real data or live data, seeing that the last report was only given at the 3rd of, sometime last week on the 3rd. So I think
They
makes more
test to see
sense.
what they can get away with, right? And then they get away with it. And now what? Now we're lost. What used to be a professional standard, which was given all the time. Now there's just excuses for why they don't need to provide that information.
All right. Yeah, no, I totally understand everything. Now, thank you so much for clearing that up, Kit, and as well as you, ICT. Thank you so much.
Great transparency.
I love it. Hey, yeah, David, do you got anything you want to add to the conversation? I mean, I love your thoughts and 2 cents. That's why you're here. I mean, period. I love everything you do. So, any thoughts, or I know you're a little not as loud as me, so I want to give you the floor. See if you wanted to add anything at all, because you always add value. I wanted to make that point. Look at them relative lows get swept. Whew. Sorry, go ahead.
Did you guys watch the high and the low of the day?
Wow. I mean, we propagate a range through macros. That range gets left unmitigated, and then they come mitigate the range. So propagation and mitigation of ranges are, 2 things that we learn and that we trade. And I thought today, I don't want to leave it go unnoticed, but Michael talking at length about the importance of, at least in this room, the CE, the mean threshold, the midpoint. Man, oh man. If you guys only knew how important it is to study that, you can really, really do a lot within your own understanding of what the market is anticipating on doing with just you understanding a range formation and price's relationship with the previous range is 50%. Because Michael's already taught if we're bullish, what happens within a previous range? Where does price go? Does it want to go to the 50%? Does it want to go into discount? Or does it want to stay above 70%? Does it want to stay above the first quarter, within the quarter? We want to see order flow right there, maybe discount 61.8, but we want to see it level right around 70, 71, 72, and we want to see bullish order flow reaccumulate in the top quarter of a range so that it can continue distributing higher. And similarly, on the lower quarter, and these are things taught by Michael, but these are things that we reiterate within microstructure, within macro structure, microstructure. I love it. Francisco, you got anything you want to add? We're at 1:30, 1:25. I like the time.
Hey everyone, hey Kit. I'm glad everyone's doing well. I hope you're doing well. If you're struggling, hopefully we can help a little bit. So I wanted to talk more about speed, and
It's
some of the
so important.
violence.
It's so important.
I've been doing. I haven't finished this, but I did a bit of like a. Well, I've noticed a lot of wicks this March delivery contract. There's a lot of wigs. I'm seeing like a lot of drastic moves, and I've been staring at the charts coherently, or a little more coherent, since 2023. So I've seen a full year at least of price movement, and this month's really looks like ugly. Like a lot of wicks, a lot of big candles. And so I got like an Excel sheet of like 1 minute candles and looking at the highs and lows, kind of to measure like if I'm actually seeing more violence in this delivery contract, and I'm gonna compare it to like the readings I get on another delivery contract. Like for example, last one's December's. So that's a little study I'm doing with violence and speed. So yeah, I just wanted to touch a little more on that because
Speed's a big deal. Michael talked about inefficiencies being left open on one side of the curve. On the 5 second, on the 15 second chart, you're looking for those volume imbalances, those gaps, those FEGs to form and then not be filled. And then when that happens, where on that specific chart, where could you map the previous equal highs or lows? And where and how quickly is price looking to go? V shape responses. Uh, I know my boy Dodgy likes V's within his trades, and V's also incur or in they imply speed. Typically, a V stands for velocity, right? So a V is speed. And when we see a V like response within price, those are when you see relative equals get swept and then that violent response in the opposite direction. We love seeing that as traders. It's a great way to determine whether we are on side. That is, again, something within the conversation today that Michael is presenting is speed, velocity on the chart. V shapes. Dodgy D, you want to jump in here, buddy? Add you to the convo.
Yeah, what's up? I heard V shapes in my user ring.
He said V. How you doing,
I
buddy?
know. I'm doing great. I had a great morning trading, so I'm just getting a tan now.
Nice. I saw I was in your Discord a little earlier. I said hi. So
Oh, you did? I didn't see that.
yeah, no, if you look in the comments, I said hi. But yeah, I mean, you seem to be bullish a little before I was. I wanted to see a little more of a sweep, but you put your stop a little different than mine. Would you say that your stops are to the specification of how inversions are taught?
Yeah, I mean, pretty much. I just kind of have my own like intuition stop based off of years of just watching the chart. Like I can just tell when I'm about to get wrecked,
Yeah.
and then I just get out. Like if it's like a giant nasty death candle, it's like it's going through the midpoint, it's going through the whole inversion. Like I just usually cut the trade, because like my winning trades won't do that, and I don't want to be in trades that aren't going to do that.
We want to
I'd,
be
I'd,
we like
yeah.
speed, right, buddy? We like speed.
Exactly. I'd rather be in trades that are just going to hit my TP, not take too long. And if it's not going to do that, then I'm not going to participate.
Well, when you really kind of track and measure, and that's, I think, what's interesting within the conversation today, even mentioning about inversions, bringing you into the conversation with what Michael spoke about earlier, and that is the 5 second chart, the 15 second chart, these inefficiencies that end up being left open, where and how you, the trader, can utilize that as a tell.
Oh, for sure. Yeah. Yesterday I was trading. There was a 2-minute inversion. It was a little after, like, I think it was around 10 o'clock. And we closed above the gap. And I tell people, I'm like, this is a breakaway gap. We should not retrace back into this gap. We should just speed up. And people are like, how do you know that? How do you know that? I'm like, it's just like, it's just like when you know a trade's gonna go to spool the buy side, like you know that an imbalance should be left behind just based off the speed. You know what I'm saying? So it's just something I watch for all the time.
I think
Agreed.
speed is so important. I think fib levels are a good place to look for speed. I placed earlier, or we were also talking a lot about gaps. If you look at a previous week in fib levels, the price, what was it on NASI at 346 is also where midnight is at. And if you put a previous week's high and low, and then your classic, 0, 1, and then 618, you'll see the entire day today we've been bouncing off of that 346 price. But when we look for speed, we're going to see closure typically above or below that price, and then you're going to see price fill, relative equals, unmitigated ranges or gaps or inefficiencies. So fascinating thing. I posted it. Pretty please take a look at where we were, just a classic fib 61.8, and that's at midnight, by the way. So midnight happens to print on a previous week's 61.8. Go figure, right? No way. Must be random.
Do you think we're gonna go back to the New York AMLO?
I think NQ is so forced in regards to inefficiencies that it can do whatever it wants within 1,000 points, and you can't really say much about it. So
Yeah.
it
I mean,
literally has. I mean, we're stuck between the weekly open and the monthly open coming off of the 61.8. So I personally, for the previous weeks, as I mentioned before, the 346 would act as my floor or ceiling, mate. So I'll be a bear when 46 is my ceiling, and I'll be a bull when 346 is my floor. So right now, 346 is my ceiling. So 618 is above us. So I'm really looking to see what equal lows we could be looking for. And I mean, we're also dealing with a lot of these, gaps, right? And we mentioned that before. There's a lot in the way of previous open ranges that we have propagated, but we have not mitigated. So I'd be looking for potentially the downside in that.
Yeah. I'm
Yeah. So
looking.
I'm ultimately bearish, bro. Yeah.
Yeah, I'm looking for the. I don't know if you. I'm looking for consequent encroachment of the hourly fair value gap, the bullish gap we formed yesterday at 10 a.m. We came close earlier, but we never hit it. So
Right on. Right on. Right on. I mean, we've only moved 28% of our range, 191 points today, after we've been, explosively over the last 2 weeks in ranges that are averaging over 600 points.
yeah. Do you
So,
like? Question.
tiding.
Do you think February has already been better than January? Because I think it's been way better.
Oh, it's been way better. It's more loose
Yeah.
I
in the
mean,
gap.
bro, February hasn't even started yet. Do you
I
realize? I
know, but
mean,
this week looks promising, man.
yeah,
This
no,
looks
this week looks
promising.
good. This whole month looks good. There's a lot. I mean, as we
Yeah.
progress and move on, we're just getting out of the yearly open, right? So,
Yeah.
what do you? So, do you like NQ a lot? That's all you
Who, me?
trade, right?
Yeah, literally. I only trade NQ. I mean, I look for SMTs sometimes, but I hate SMTs, dude. If I know the draw and liquidity, an SMT is not going to get in the way of my draw and liquidity.
SMT is a confusing factor, I think,
I
for
know it's
newer
so confusing
traders.
for people. I know.
Having had to try to explain it to folks a lot, it ends up being one more element that ends up, instead of adding confluence or strength, for a lot of folks, it can
It just adds
become one more element
confusion.
of confusion.
Yeah,
And
literally.
that's where I think there's a lot of controversy around SMT too. Is that for some folks it adds to their conviction, and for other folks it adds to their confusion. So
Yeah.
I mean, it is what it is, but it makes sense. I mean,
The controversial SMT.
and SSMT.
as
Dude,
well.
it's dude, I know
Hey,
someone. I know one of my students who I obviously did I talk about inversions, and one of my students oh, have you ever found the SMT model? I'm like, bro, enough. We're not looking for that,
I know. No, we're not looking for that.
Yeah.
I love this year's mentorship is all about making it easier, and all you need, boiling it down to the core fundamental standard operating procedures, the specifications, the if-then statements, the logical trees. It's already been explained. If you want to find out further information and knowledge, you literally just go back to the episode. You refer back to that month. You refer back to that series. Otherwise, you show up prepped, ready, and, taking notes.
Yeah, man. So like that's why I wanted to talk about speed.
Speed,
That's why I
I
was trying.
believe, is going to be part of the conversation. I mean, Michael's made it clear. At least I'm reading what he's saying today and what he's said. I believe speed and velocity are going to be elements, especially within the sub 1 minute chart. You're going to be able to see it again more so than you're going to see it on these higher time frames. You're not going to see speed on a 5 minute the way you're going to see speed on a 5 second. It's just not. And understanding conceptually, fractally, that that's indeed what's happening is that you're also studying speed, is you being able to understand the inefficiencies that form within the propagation of a range. Because
Mm-hmm.
ranges propagate, that means they form, and then ranges mitigate. And that means once after they form, they get repriced into. And that's where we're looking for the inefficiencies, the relative equal lows. That's where we're looking for the high time frame, the multi time frame confluences towards creating trade plans and ideas.
Right. And so that with trade ideas, being back on that, like I think a lot of people here are new because that's what I've been hearing, or at least they haven't reached a level of where they feel confident in reading price. And so like one of the insights that I found is basically when we're looking at, let's say, a 1 minute range, let's say it's either consolidating or it's like in high resistance, like inching lower, or inching higher. It's just kind of like some wicks, bodies overlapping. We don't have a clear, a clear gap anywhere near us. I think one of the things that really helped me read price is to wait for that violence. Like we'll see a range that has a couple of wicks that are making these little highs, and price hasn't left any gaps. It's overlapping each other, and then all of a sudden we see a 1 minute candle which body goes above the previous highs, the previous wicks. And so when it moves really aggressively higher and it's just breathing, right, it's pumping higher, and then it's just kind of resting up there, just kind of moving a little bit lower, a little bit higher, and it's leaving a little bit of a wick on top of it. When that 1 minute candle closes, we're either going to see a reversal or a wick. It's going to overlap the body's gap that was left, or we might continue higher. Depends on, we don't know. So I think that's one exercise that really helped me kind of observe price and actually pay attention to what it's doing, because a lot of times I've been looking at price, but I'm not really paying attention to it. Like I'm not really seeing the vocabulary. I don't really understand what's going on, So like, for example, that exercise of waiting for that movement, we really see some speed, helps me be more attuned to price. And I don't need to catch all the moves. I need to be able to catch and frame the moves that I'm able to see. Like you're going to see your move every single time, but you need to identify exactly what that is, right? Is it a gap in a premium of a range, or is it a different gap in a discount of a range? Is it the second gap that it made, right? Is it the first gap in that impulse that we made, because then it left like two other more gaps higher up, right? Or is it, you have to understand what these gaps look like in which time frame, because a 1 minute time frame gap doesn't look the same as a 5 minute gap, right?
Okay, hey, to
So
your point, Francisco, and in my comments, I just want to add again breadth to
yeah,
the conversation. We are being asked. Well, there are haves and have-nots here in the conversation within the ICT community. There are folks who do not have the 5-second or the 15-second chart, so we're talking about something that they don't have or don't have access to, and they're saying, "Well, what about me, Kit? What do I do? I don't have access to the 5-second. I don't have access to the 15-second. What do I do?" Stay focused on the one. Focus on
yeah, the
what you
one
got.
minute. Yeah,
Focus on what you got. I mean, I understand different folks don't always have access to the same thing. But what is being taught and what we're going over are, microstructure. So you're going to be able to look at microstructure within a 1-minute chart. That's what it is.
I
So,
find it. If I could say one more thing, my
yes,
wife's
sir. Yes, sir. Yes, sir.
my wife had to ask for permission on this one. She's looking at me. How many more are you going to do of these? All right. So I heard what you just said about the lower sub 1 minute data. And I get this a lot in the YouTube channel comments too. They're like, I don't have that. I don't have that access. I'm trying to learn this for free and that's the other thing. So I think it's reasonable to say this, even though it won't feel reasonable receiving it if you're in this portion of the community. There's this misnomer that you can learn how to trade without any investment at all on your part. And I'm going to tell you, you can get to some measure of aptitude doing everything 100% free. But if you want all the advantages that I'm making available with the lectures I'm doing this year, you will have to avail yourself the 5 and 15-second data. And I don't care where you get it from. I don't have an affiliate with TradingView. I could be making money with them by telling you to do it. I declined it. And like I said, if you all doubt this, I will show you the screenshot. I will live log into TradingView and you can see that the person asked me if I wanted to do it. And I said, no, I don't do it. I don't ever do any kind of affiliates. But you don't necessarily need what I'm teaching this year. You don't need it because everybody else out there has been making money not using what I'm teaching this year. They don't even know what I'm teaching yet. And there's people making money all over the place doing stuff. They're trading 1-minute charts, they're trading 5-minute charts, and 1 hour charts, they're trading a daily chart. They're just using what they are comfortable with the resources they have. But if you're trying to make money, okay, think about what you're talking about going into the highest form of financial careers stemming around money, currency, and you want to do it with no costs, no investment on your part. You want everything for free. You want everything just to be the cost of your evaluation and then get rich. And I don't think that is a practical perspective. I don't think it's realistic. And if you are sincere about doing this, you will invest in yourself. You're not buying anything from me, okay? But you will invest in the tools and the resources that people that know what they're doing are illustrating. This is what we're getting the information from, the data. And it's your choice to avail yourself with it or not. It doesn't make a difference. But you don't need this to do well. But for the people that are sincere about it, they're going to make, whatever concession they have to get the resources, you're going to invest in it. It's not even that much money, man. I think if I'm not mistaken, I believe it is like $8 to get live data.
yeah.
And then I don't know what the platform costs are for it, but at some point you're going to have to make an investment in yourself. And that's a really good litmus test, because if you've been pretending that you've been studying, if you've been pretending that I watched some videos, I did some journaling, you're going to know that you've been doing the research. I have students that have like PhD level like notebooks, and I'm impressed by what they've done. I'm like, wow, this is crazy. Like, this is really, really good. It's better than I would have done if I was marking it all up and try to teach it just from the text perspective. But they have taken it serious. They took it upon themselves to say, hey, look, I'm worth this. So if I have to have a second job, if I have to sell certain things to afford, a couple months of this stuff to learn how to do it. Because once you know what you're doing with it, If it requires you to stop paying for it to save up money, make some changes in your life, then that's fine. Because it's like riding a bicycle. Once you know what it is that you're utilizing these timeframes for, it's for practice first and foremost. But then you can transition into higher forms of precision, risk management, stop loss management. Everything will be enabled on a higher degree of precision with these lower timeframes. But if you don't know what you're doing, just because you have these lower timeframes, it's going to be the perfect excuse for a fool to get out there and say, well, there's a fair value gap. Let me buy that. Let me sell that. That's not what you're supposed to be using them for. Okay. That's why I waited this long to teach this stuff, because it would have been communicated erroneously by a new student or a new trader coming to me and saying, well, ICT said this is the only way to do it, and I'm going to trade it, and I lost a lot of money. There's a lot of setups that fail because I'm looking for this, that, and the other thing, and not know what it is I'm teaching this year.
Highly technical skills. That's what he's teaching you guys. And he's telling you a highly technical skill can be refined and enhanced on a lower time frame. Period. There's no arguing. There's no, but I can't. Okay, if you can't, then you can't. Okay. Find a way to invest in yourself. From a community standpoint, this year, it's really about refining your technical analysis. And you're doing that in high definition. You're learning it for free. The fact that you need to invest something into yourself, guys, it's just what it is. You have to invest in yourself. You have to invest in yourself, which is going to be time and energy first and foremost. We're all here for it. But then you're going to have to scratch up some change. And I know for some of you, you're going to be like, yeah, but Kit, you don't understand. And I'm just going to say I lived in a third world country voluntarily from 18 to 25. So I do understand. I do. I know it's rough in the streets. And I also know income disparity. But you got to do what you got to do. And that's it. That's it. And then you show up and you're ready to play. And let's go. High five. We're on the same team. Let's go. So that's what it is. DeMarcus, you want to jump in here quickly? Guys, we're going to be wrapping up here ourselves here. We've been here a little bit. It's been a wonderful day. And 147, I like the prime. Just saying. I like the prime.
Hey, what's up, kid? Can you hear me good, bro?
Yes, sir, I can. We're going to go probably about, 13 minutes. I'm going to be wrapping up here around 2 o'clock. Try my best. 13. I like that number too. Go ahead.
All right. Thank you. So I'll just say real quick, man. I know there was another guy on here earlier named Ryan, and he was talking about how he felt lost, and he said something. He gave me what I've been wanting to say. He set it up perfect. So I kind of had a similar story. I started trading back in 2020. Found profitability back then with retail. Then started learning smart money, and it was a struggle. Has been a struggle to find profitability since I started back learning smart money, and I stopped trading about 2 years ago. It was right around the time when the silver bullet first came out, when ICT first started teaching it, and I had just started working night shifts at my job, and it was too much for me. I kept missing the setups, and I was like, you know what, I'm gonna just take a break. Whenever I can get a better schedule, then I'll start back trading. Fast forward to July last year, I started back trading, and I went through some of ICT's 2024 live streams. I went through some of the 2025 live streams, and I've been listening to the podcast that he's done on here. I've been listening to those like every single day. And one of the things that I want to say that has helped me the most is to take the money out the way. Like people, it's like when you're trying to learn this stuff, you cannot be on the funded account trying to learn this stuff. Like, yeah, you may have some hits here and there, but to really get it down, and this is coming from somebody who used to be profitable, you know, um, you gotta remove the money out the way. Back then, we used to pay like $500 for a 100K challenge. Now it's so cheap. you can get in these prop firms, and it really mess you up. So something that helped me is journaling. ICT talk about this all the time. I've been journaling all of my trades, and like the growth is crazy. Um, Also, I passed some funded accounts, seen some profits, wasn't able to withdraw them because I was too impulsive. Right? I work at a casino. I don't gamble, but it being in that environment messes with my psychology. Right? So I've been dealing with that lately, but I took a break, went back to it, go paper trade. You know what I'm saying? Paper trade it out until it gets boring and you having profitable weeks on the paper trade account. Like I feel like right now I'm at a confident spot to where okay, I'm ready to go ahead and get back in the funded account and reach profitability. And my confidence is there because I've been doing it on paper trades to the point to where it's been boring, right? And I just want to say to new people that's listening, take the money out the way. Like ICT is going live this whole year. Like it's crazy to me because when I first started learning, he wasn't going live, right? So to be able to have him going live is a blessing. Hop on, take notes, and paper trade until you know what your model is, you know what you're looking for, you know what time you're getting on the charts, and you know your risk tolerance, how much you're comfortable with risking in a trade, and stick it out until you get more comfortable to put real money at risk. And then what y'all are saying about being able to see the lower time frames, yes, make that investment. Make that investment because you'll be able to see way more setups happening on lower time frames. And if you journaling every trade that you take, that's another opportunity for you to learn and get better every day. So that's all I wanted to say. I know, we in the macro, you wanted to finish up before that. So appreciate y'all.
He said we're in the macro.
Right?
I love that.
We're all looking at the chart right now, right?
No doubt, low key. I happen to be eating a sandwich, but Slick Rick and Ty the Fly guy, come on and jump up in here, guys.
Yes, sir. How's everybody doing?
Pretty good. Yourself?
I'm okay. I'm okay. My name is Elliot. I appreciate being in the community. I've been studying ICT concepts. I think going my fifth year now. The mark has definitely touched on some good topics just now. I do also want to just hop on that as well because the lower time frames, when you have the ability to watch them, you can train your eye, in reference to the higher time frames. And once you see what you're looking for over and over and over again, it just becomes like clockwork. But I did have a question regarding like the concept of the power of three.
Ooh, I love the power of three.
So do I. One of my favorites, one of my very favorites. So I typically like to start off on a higher time frame. I look at the weekly profile, daily profiles, the NWOGs, the NDOGs, all that good stuff. But when it comes to, anticipating a direction for the day and utilizing that method, sometimes it's hard to see when and where, if it's going to actually be a great expansion phase during London, or if it's going to be a consolidation day. So I was wondering, is there any way to kind of hone in on that a little bit more with accuracy so, so
Okay,
we can tell the difference?
economic calendar weekly profile. What am I going to say about that, and where would I find it?
What is it? Forexfactory.com.
Forexfactory.com. Yep. And then on ICT's channel, what are we talking about? We're talking about core content, month 10, episodes 5 through 10, indices. We're talking about profiling, weekly profiling, price projecting. So we're going to find that core content month 9, right? Price projection. We're going to look in Core content month 12, look at the high time frame, kind of begin with the end in mind. So you're asking, how do we anticipate an accumulation? How do we anticipate these consolidations? Well, we look at the economic calendar. We look at where we are at within a month. We look at where we are at within a quarter. We look at where we are at within a week, right? And we're anticipating. I might not get the strongest distributions coming off of week one of fill in the blank month, like I might get on week 3 or 4, right?
Right.
So the accumulation is
Hmm.
naturally going to be typically towards the beginning of our open, of what our open range is, of our point of reference, which is open. Right now, what are we dealing with right now? February, what are we dealing with? Yearly open, quarterly open. We're in Q1. We're in month 2. So we have month 1. Now we're in month 2. So we're at the beginning of month 2, which isn't going to be as frisky maybe as the end of month 1. End of month 1 sure the fuck was, wasn't it? Little black swan event in the metals, right? Got a little squirrely there at the
Yeah.
end. So anyway, point being, at the beginning of the month, we have, so we're month 2, quarter 1 within the year. So how do we anticipate accumulation? Well, we start looking at AMD and we start looking at where we're looking at in way of the opens. We got a monthly open, we got a weekly open. That's what we're consolidating right between right now on NQ, isn't it? Monthly open and a weekly open. Go figure. How do we get on side with understanding these open ranges? We go back to gaps. Why? They're bigger. Why? Because they're draws. Why? Because they propagate and then they mitigate. That means price has to go into them once they form, and then it will leave. That's going to give us an idea. So if it's a gap and go, that's a model, right? If it's a we open and there's a gap and price retraces back to a previous close, that's a model.
Don't we have 3 sessions a day too?
Ooh, I love that. AMD,
Yes,
Asia,
sir. 3
London,
seconds.
and New York. I know David, his FX for living model, very, very, very much based on
Yeah,
ICT's
that's
teaching, is
classic
incorporating.
day, right?
Yeah, do you want to pretty please elaborate a little bit on that model with the ICT based model that you trade, buddy?
I mean, it is the classic day, basically, you know? Like, so I started on Euro USD with that model specifically. So, you know, Asia session, London session, and basically New York the next day. I mean, overnight, right? So, yeah, it's pretty much that. Like, that's the power of 3 of the day, right? And that's what I was trading. And I'm still trading it, so.
Yeah, I love that. I just want to add, I mean, one of the look back ranges for the FX for David and the model he utilizes is a 9-hour look back, right?
Yep.
So you're looking at the FX open of 1700 and then you're looking at 2 a.m., correct?
2 a.m., yep.
Yeah. Interesting timing. I want to add one of my favorite time frames to look at, and it's reflected in ICT's models, and a lot of folks don't think about it, but it's the way in which specific candles open, and that's the 11-hour chart. I like the 1600. I like the 1800. I like the 5 a.m. I like the 11 o'clock, the 11-hour range. It's fascinating. It goes back to so much of what ICT is taught in the way of the central bank dealers range, the Asian range, where and how we're looking at midnight and the swings that are coming out of midnight. Like today on NQ, I can't believe it. The 61.8 of a previous week is on midnight. Go figure. Can you believe that?
Time and price, right?
It's wild.
I mean,
So
it's I mean, it's there every day, you know? Like,
it is, buddy. It is. We're at 2 o'clock, so we are right. We are freshly at the half of a macro here, going into the 4-hour, close into the open. See, that's something else when we talk about macros. I want to end on this note. Macros, I like macros that have that multi-time frame confluence to it. 1400 is a good example, right? with a 4-hour candle opening and closing, with it being the 50-10 of simply one single hour. But that one single hour can have this reverberation into the market that has a higher time frame distribution. So therefore, it's interesting to me.
I have a question.
Yes, sir.
Another one.
Yes, sir.
So when I hear a lot about the hourly macros, like the 10 minutes before, the 10 minutes after, but I haven't dived
Studied
into
it.
that
Yeah.
subject. Yeah. So like could you touch on it a little bit for me? I would definitely appreciate that.
What's this thing ICT calls 50-10s, right? Is that the question essentially? Like, I heard of this thing. It's called the internet. Once it gets popular, it might be used by some
Yeah.
folks.
I can Google it. I can Google it.
No. I got you. It's a good question. It's a good question. What's the importance of the 50-10? Short, easy answer. Fractal delivery. And when we look at the hourly, I think it's super interesting. ICT, he asked the question in the live stream. We're in Trader Roundup, but I'm not sure. But how long is New York? Does anyone know? How long is the New York session? How many hours? How many minutes? Michael asked the question earlier. I don't think there was an actual response. 390. Anybody? 6 hours.
minutes, maybe?
6.5 hours? No, 390 minutes. So you're going from 9:30 to 4 o'clock, right? 1600. I know you guys got to do all that math because you guys think everything's on this H4 or H6, right? Who could possibly imagine the market opens and then it's actually 6.5 hours? It's 390 minutes, right? Isn't that wild? 390 minutes. That's how long New York is dictated from open to close. Because what's interesting is if you anchor that same 390 to say something like a 2 a.m., 6.5 hours, what do you get? 8:30. Interesting. What if we anchor at 4 o'clock a.m.? What if we anchor 6.5 hours? What do we get? 10:30. Interesting. So 6 hours, the magical, mysterious 6 hours. I'm here to tell you 6.5 is way more interesting. And New York tells you that, not me. How long it chooses to be open and closed tells you that, not me. It's just a very interesting observation when we look at ranges that are propagating, that are forming from specific times to other times. And then what's the 50%? And where's that at? And why would you want to trade from one side of a range to the other? Which is the whole conversation we're having. 2:02, I like the time. Very harmonic. Anyway, I think we found a place to kind of leave it. Just because we're going to be back, we're going to be doing more of it. It's recorded. There's a lot here between episode 1 / rug pull to part 2, episode 2 of Trader Roundup today, and where and how, Michael is going out of his way to participate with you and engage with you and mentor you personally. If you come in with the right question and the right energy, you never know. You might get that response that, I'm pretty sure CR today is going to appreciate that mentorship he got. And anyone that goes back and listens to it's going to really value and appreciate it too. So with that said, we are going to leave it here, ladies and gentlemen, just because we know we're going to do it again. So pretty please share Trader Roundup. We have part 1 and part 2. Share it on your page. This is kind of like the secret gem. And folks have to go out of their way to find it. Trader Roundup is the Easter egg. And if you are not engaged with Trader Roundup, you're not going to know anything about the IFEG. You're not going to know about the second stage distribution. You're not going to know about macros. You're not going to get the clarity of lessons, the anticipated delivery of what was wanting to be said. And fortunately, Michael, gets to hear what you understood. So we get that sharpening of the sword, real time, the finger in the pulse. It doesn't get any better, ladies and gentlemen. So with that said, thank you for being here. Thank you, everybody, for your time. Thank you, Michael. Look for, go to Kit Trades on YouTube. We're going to be pushing a lot more of the content there.
And then also look here. It's going to be here. It never, ever goes away from here on X either. So be looking for it on the Kit Trades YouTube channel and or here on X. All right, everybody? David, thank you for co-hosting with me. I can't wait to
Can
see
I
you
get
again.
2 minutes, please?
You can, Hamoudi, because you want to know why.
Please,
You
can I get
asked.
2 minutes?
Yes, sir, you can. Because you asked, because we love you, and because high five, buddy. Nice to see you. Go ahead.
Thank you so much. I have some questions to I want to ask Michael.
But you realize he's
I
not
will
going to
just come
answer,
to the
right,
point directly.
Hamoudi? Right? You know he's might not answer. Right?
Anyway, I hope he. Okay, I
The
hope he will
question will be
listen.
here
Don't
for
worry.
posterity's sake. Okay, go ahead.
It's yes, yeah, okay. In 2025, in last lectures, he mentioned that high probability fair value gap come on quadrant levels. Okay, and then in 2026, he said no matter what, always the inversion fair value gap will be low risk entry for smart money. After the total soup, inversion fair value gap will be the low risk entry. Okay, now my question is the inversion fair value gap, the fair value gap come on quadrant levels can become itself inversion fair value gap, because inversion fair value gap is very powerful.
You're imploring and inviting people to a conversation, and I'm not even sure the question.
Maybe you can reformulate.
Yeah, I'm not sure anyone can answer that, Hamoudi. Thank you, David, for helping me add clarity there, because I don't think we understand, brother. Honestly.
All right, no problem. I hope Michael will hear at that, and someday he will answer for that.
No, but let's try and understand the question, brother, while you're here. The inversion fair value gap forming on the quarterly.
No,
just
no,
amplify the question.
Yes, on the quadrant
on the
levels,
quadrant, quarterly quadrant. I'm sorry. Go ahead.
Yes, like any you grade any wick, or let's say opening gap. Opening gap have quadrant levels, right?
Yep.
And the first presented fair value gap become on, let's say, upper quadrant level. It can become itself inversion, because inversion fair value gap is always low risk probability entry for smart money after total soup, after model 2022. Model 2022 can be standard fair value gap, but for inversion fair value gap form on quadrant level, it can breach to upside and make it inversion fair value gap, because the quadrant level fair value gap is very powerful. Like
David, do you understand? I mean, he is definitely trying to ask the question. I don't understand what he's asking. I don't.
It's better. I just think it needs to be formulated different way. Like, but I don't understand as well. Like, in my opinion, I think
this is
like
he mentioned. I'll tell you, he lectured this in 2025 second last video, and then 2026 in the beginning videos he said no matter what, the inversion fair value
to
gap
say
will be always
the way your verb.
low risk
No,
entry.
no matter what and always are not things that Michael says. Okay, he doesn't say no matter what and always. So you stating that that's what he says, you're incorrect. He does not state that the market is always going to do. Those are not the words he uses. So you're putting words in Michael's mouth in which you want a response from. He does not state that.
No. I'm not saying that. I'm stating behalf of him. I just want to ask this:
Okay,
the
I get it. I understand language. I understand the language is a challenge, so that's fair. Do me a favor, Hamoudi. Jump in my DMs and ask the questions, because we've ran out of time today, boys and girls.
Damn it!
Yeah, I know, right?
All right. Okay, thank you.
Okay, I got a question real quick. Technical, if we got.
Okay, all right. That's no problem. I don't mind. If we got some technical questions, and there are folks here, if you can be salient, on point to the topic, then that's fine. I just don't want to get short with some of these questions. That's ending. It's just not. It's not it.
Definitely, man. Slick Rick here from Miami. 2024 mentorship, loving it. Mechanical. I'm actually teaching it to a couple of my friends. I've only been studying for about a year. but fighting the demons of psychology, but still seeing the progress. My question is in regards to, and I know it has been asked a lot of times, Michael's probably going to laugh, but in respect to the settlement and the contract change buttons, I'm having a little bit of confusion sometimes where I'll switch it to find the bigger gap, like he instructed us, but then you know I'll go back and then the highs and lows are different, and then I get confused. Is there any way, or is there any advice you can give me in reference to that? Like how do you align the changing of those settings to not confuse you, I guess? Because for example, you'll find a suspension block and then you'll hit the contract adjustment button, and then all the highs and lows will change. So I'm just finding a little bit of confusion in that, and if I can get some clarity on that, that would be great.
On the continuous contract or on the monthly contract?
I'm sorry?
On the monthly contract or on the
On the
continuous contract?
well, I'm on the daily chart usually, and then
and Q1?
Yeah, NQ1. Yeah.
Yeah.
You know how the highs and lows change when you hit the B adjust, and then when you click in the settlement, the gap sizes change significantly. So I just wanted to know how to navigate that in reference to not getting confused, because ICT noted a low recently, and I had the B adjust button pressed, and I couldn't understand why he noted that low, and then I changed back, and I was like, oh, he's talking about that low. So like, how do we not get confused with the switching back and forth between the buttons?
Are you on extended hour or electronic hour?
So let's say you're
using on the daily. So there is no that doesn't exist on the daily. I don't know if Kit can chime in on this, maybe.
If you're using like NQ1, you can go in your setting in symbol, and there's like an adjust for contract change there. Like you can check mark, and there's like an question mark like logo. You can read about it and understand a little bit better how they overlap these contract change on a continuous level.
Right. No, I understand that. And ICT taught us to look for the largest gaps, but I'm really asking about the adjustment button where the highs and lows change, and that throws off your analysis basically. So like, how do you know when is proper to use each one, if that makes any sense? Maybe not. I don't know. Hey, Kit, you're muted in case you're trying to talk.
Pose the question on Twitter, okay? Send me a screenshot and ask me the question, and I'll respond to you.
All right, sounds good, Mike.